Clearly make equities more attractive than bonds. And if you look historically at the real return for a 10-year investor, they're getting, 2.38 today, and inflation outlook is around 2.2. So I can't imagine them being content with a very disappointing real return of only 18 basis points.
But everybody seems to think it's going to get worse, that inflation's going to get worse, growth is going to get worse. And so what you're presented today is much better, including, in the bond market, than what you're going to be able to get in 6 months or 5 years or I guess 10 years' time.
We're not seeing downward revisions in earnings. So in terms of being an equity investor, there are fears of slowing, but we're not seeing it hit earnings yet for the next few quarters.
And Mike, we are not seeing the 10-year yield back at the lows of this cycle even. We're still a full percentage point above that. So is there room for yields to keep moving down? And do you agree with how Craig's analyzing it, which is not so much that it's a warning sign for the stock market, but that it makes stocks more attractive?
I think both of those things can be true. It supports stock valuations because on a relative basis it does, well, first of all, even on a real basis, it makes debt costs lower and all the other things. But at the same time, it amplifies this message that the world is going to struggle to grow much, at least in the first half of this year. So I don't necessarily think those are in conflict. It's more about the bond market is maybe a little more of an extreme version expressing the anxiety that we have in stocks. But by the way, yes, Bob was talking about fighting out this battle around the 2,800 level, the S&P 500. During this year, we're up, whatever it is, 12% for the S&P 500 at this point year to date. You've only had like 2 to 3% pullback. So it seems severe in certain segments of the market, but the overall market is staying supported in part because of those sectors that do really well when rates are low.
Like technology. Yeah. Craig, where would you be? I mean, what do you think is the correct positioning for investors in this environment?
Well, the leadership over the 10 years of this bull market has been financials, consumer discretionary, technology, industrials, and we expect that to resume. We're value investors, and we can easily find value in those sectors.
Did I just hear you say you think financials are going to resume leadership? Because very few people, that's been a hard-hit part of the market the past year or so.
People worry that a flattening yield curve is bad for banks, and I totally disagree. I think bankers can take money at one rate, mark it up 3 percentage points, and put it out in their sleep. They're that good. So I looked at the index for regional banks, and their profit margins and their interest rate margins have increased the last 4 years while the yield curve has been flattening. They can do just fine.
We're going to talk to KeyBank coming up in just a little while. It's the same thing, by the way, Anton Schutz told us the other day about investing in the banks. What about so you mentioned technology, consumer discretionary. I'm not hearing you say, look at the defensive parts of the market. Is that because the valuations are too high? You just don't think their growth is as attractive?
Probably both. People are clinging to them to be defensive, so we don't get the values there we get in the more out-of-favor consumer D and industrials.
And Mike, today we have some of the all-time high names here in stocks: Dollar Tree, Starbucks, Ulta, Pepsi, and by the way, ADP and Paychex. That's a pretty good sign for the U.S. economy.
That's true, and also very kind of steady growth companies. So the market has really been gravitating to these areas, not just companies that have dividend yields and you can get income, but where there's essentially some resilience to the earnings growth over a long period of time. And I think that's where you're seeing the new high list. These brands that travel, like Starbucks and Nike, have been very good. It reminds me a lot of 2016. You mentioned when Treasury yields made their lows the last time. It was also after a big market shock, late 15 and 16. And for a while, nobody was sure if this earnings recession was going to last. We're going to pull ourselves out of this global growth slump. And this is exactly what happened. Yields stayed very low. The defensive parts of the market kind of held the tape together for a good stretch of time. And then after that, in the middle of the year, you had Brexit.
Yes.
And finally, though, you got earnings inflecting higher. That's probably the bull case right now, is that we're just kind of, biding our time. The defense is on the field, trying to preserve the lead, and maybe we can go to offense after.
Mike, we're shifting into baseball season now.
You're right. Today, literally.
Yes. So, Craig, finally, people will say, okay, we understand mathematically why low bond yields help stock prices, but is it just, frankly, something kind of a bubble? It's because of Europe, it's because of China, or it's the Fed's fault? It's going to inflate the stock market beyond what is fair value. How do you think about the value in the market? You said you're a value guy.
Yes, we never use PE or price to book. We think they're very deficient. We compute intrinsic value, and we find the market today to be about 9% below our estimate of fair value. So with earnings growing, value growing, we think it can be very supportive of higher prices over the next year.
How do you get intrinsic value?